Started. So again, welcome to Applied Equity Analysis. My name is Joe Perfetti. I'll be the instructor for the semester. I've been teaching Applied Equity Analysis at Smith for about 6 years now, and this is my second time teaching in the MS program. The key to this class is that it's going to be applied. In addition to teaching here at Maryland, I do a lot of consulting work with companies, a lot of valuation work, and a lot of work with trading analysts on how to write the buy, sell, hold recommendations. So that's really what is going to differentiate this class. Again, the key word here is applied. We're going to make this class very practical, very real world, and essentially teach you the major parts of how to evaluate a stock so that we can apply a proper valuation and think about whether or not we want to put a buy, sell, hold recommendation on the stock. So just a couple of logistics for the class. This is my email address. That is my cell phone number, which is available on my iPhone. Email is generally the best way to get in touch with me, but if you need to, you can call my cell phone. My office is 4468 Van Munching Hall. I don't have much in the way of office hours, only because I'm teaching 5 classes this semester. So as soon as I'm done with this class, I have 4 consecutive undergrad sections that run from 11 a.m. until 4:45 p.m. So the rest of the week, I am actually out there as a practitioner doing work in the real world. So I'm only really on campus on Mondays and Wednesdays. I don't know why the textbook did not show up in Testudo, but basically the textbook you're going to need this semester is Valuation, the 5th edition. Typically the bookstore sold the university edition, but the standard edition or Kindle editions are acceptable. The key is you will need the 5th edition. It came out about 3 years ago, and the previous editions were completely rewritten to get to the 5th edition, so that's what you will need. Other than that, the only other reading materials will be available on Elms. I also think it's important to understand, and this is probably a good use of webinar technology today, but part of what we're going to be doing this semester is embracing Maryland's technology initiative, and we will be recording classes, posting them on YouTube, and some of our classes will actually be webinars like today, in addition to physical classes. I'll give you advance warning when we're going to do webinars, and I'll give you advance warning when the YouTube videos will be done in lieu of class. But I just want to give everybody a heads up to that. And again, the nice thing is it gives us flexibility. And also, I started recording some of the physical lectures as well in previous semesters. It does give you kind of a record of what we talk about in class that is available to be used by you to review content. You're going to need to form project groups. Since we're not physically in class today, we will be on Monday. Monday will be the time to do that. You'll need teams of 5 to 7 people. You will be working on a group valuation project over the semester. I'll give you an industry, you'll select a company, you'll do an analysis on that company, and you'll turn in a paper, and you'll also do a PowerPoint presentation. And that's going to be about 30% of your grade. So it's going to be very important to select people that you want to work with. The class will be talking a lot about the real world, so it's going to be important for you to keep up with current events as we're referring to them in many cases throughout the semester. 4 major parts of grading the semester. 20% of your grade will be based on 4 homework assignments worth 5 points each. 25% of your grade will be a midterm exam, which exams in this class are open book, open notes. You will need a computer to take the exam. So just giving you a heads up on that one. And if again, you will need a laptop as well, Mac or Windows, but you'll need to be using Microsoft Excel this semester pretty heavily. So giving everybody a warning about that one. But again, the midterm is 25% of your grade, open book, open notes, open computer. The group project I just mentioned is 30% of your grade, and there will be a take-home final exam, which will be distributed on the last day of class. You'll have 1 week to complete it. And again, that's about 1/4 of your grade. The other key thing to this class is that we will be using Bloomberg Professional pretty heavily. If you don't have an account, you will need to get an account. As a matter of fact, you're going to need to have a Bloomberg professional account to complete your first homework assignment, which will be due 1 week from today, next Wednesday. And as we go through the session today, I'll show you how to sign up. It's really easy. The key is that Bloomberg Professional is ridiculously expensive software, costs $20,000 per user out there in the real world. It is free to you as a student at the University of Maryland. So the key that as part of our Bloomberg license, we have about 50 terminals at the Smith School. There's a lab in 3505. There's a lab, I think it's in 1517 on the first floor of Van Munching Hall. You can use either lab. One challenge with 3505 is I teach my undergrad sections in there on Mondays and Wednesday from, again, 11 a.m. to 5 p.m. So the lab is not available during that time. The other lab on the first floor is generally available during the week, and those labs are generally open from 9 to 5. You can check specific hours with the lab techs. But again, you will need to sign up for the Bloomberg Pro account in the lab. Our license with Bloomberg essentially says that anyone that signs up for an account in the lab is assumed to be a Maryland student and gets a free account. If you try and sign up outside the lab and you're on a non-Maryland terminal, then they might ask you for some money. The other key thing about Bloomberg is that you can go to the website, download and install the software. However, you will not be able to use the software without a license key. And the software will clue you to talk to their salespeople, and they're going to ask you for $20,000. So you cannot use the software on your own personal laptop unless you spend a ridiculous amount of money. It's free to use in the lab, and you will need to use it in the lab. All right. We follow the honor code this semester. Special needs. If you have any special needs, please see me next week, and I will try and be as accommodating as possible. On late assignments, generally, I am fairly flexible before assignment dates and deadlines are due. So if you need to have an extension or have any challenges, talk to me before the assignment is due. After the assignments are due, I tend to be less flexible about missing deadlines and typically give zeros on the assignments. YouTube. A lot of the videos for the class will be posted on Canvas and posted on YouTube. This is a link to the YouTube channel. You can also search for the YouTube channel by just searching for my name, Joe Perfetti, and those videos, including the one we're recording today, will be posted on YouTube. At the end of the semester, you'll need to do the course evaluation. All right, here's the general outline that we're going to be following this semester. Today is more of an intro day to some basic concepts. Obviously, we're going through the syllabus. Originally, we were going to try and form groups, but since we're not physically on campus, the group formation will be done on Monday. And we'll talk about fundamentals of value creation and a little bit about EIC. So your assignment between now and Monday is to get the textbook, read chapters 2, 4, and 5, potentially Appendix A, and get a Bloomberg account so that on Monday, we can answer any questions about Bloomberg and the assignment, which will be due next Wednesday. And I'll talk more about the assignment a little bit later in this webinar. In addition, next week, we will be talking about enterprise DCF, which stands for discounted cash flow, how to do an enterprise DCF valuation or cash flow valuation, and how to analyze historical performance. As part of that, we will be reorganizing financial statements into specific McKinsey formatted statements. You will need the book for this. You will probably struggle with some of this because basically we're going to take accounting statements and put them into a Modigliani-Miller economic format to help us with our valuation. So your second homework assignment, which will be due the week of February 3rd, that Wednesday, generally homework assignments will be due on Wednesday. So you have a week to do them, Wednesday to Wednesday, will be to convert the economic statements. And that will then lead into the week of February 3rd, where we will start getting heavily into Excel, and we will begin forecasting economic statements. And one of the things you're going to do this semester is build out a valuation model. So we'll begin that process to build out the valuation model the week of February 3rd. We'll then continue that into the week of February 10th. On February 12th, we'll talk about using multiples as an alternative form of valuation. And the midterm exam will be on February 17th. On February 19th, you'll have a case study to apply the valuation model that you just built. It'll be a GoToWebinar class, and you'll have to get data and use data in the Bloomberg lab. This will also be the important stepping off class because this is the model that you'll use to help you do your group valuation projects. So up until the 19th, you'll be working individually on using the model. After the 19th, you'll start working with your teams on building out the valuation model for the company that you select. And we'll be selecting the companies during that week of February 10th. Next, on the week of February 24th, we'll then talk about how to interpret results, how to refine valuations and to understand what the valuations are telling us. And then we'll actually start continually to perform and apply valuation exercises in class. And as part of the next homework assignment, you will be performing sample practice valuations on real world companies. Like last semester, we did Costco, we did Best Buy, we did, I'm trying to remember who else we did, several other companies. I think we did Walmart. So again, we'll pick some companies in the real world and do valuations, probably based on who's in the headlines at the time of that week of February 24th. March 3rd, because you're not going to have a lot of time to finish up your group project, I'm going to give you some time in the lab to work on your projects during that week. And I'm also going to give you some additional case studies that will help you work on your group project. And then your group projects are due on March 10th, which will be our final day of class, quick semester. During that class, you'll hand in your group project papers, which we'll talk more about as we go through the semester. And you will also do a 20-minute PowerPoint presentation. So each team, and I expect to be somewhere around 5 teams, will basically deliver your PowerPoint summary of your group project, and then you will turn in a paper. Once we've completed those, we'll then hand out the final exam. It'll be a take-home exam. You'll have until the 17th to complete that exam. Here's a brief outline of what is going to be required in the group project and a little bit of information on how to create a Bloomberg account. But basically, the 4 major themes of this class are outlined in the group project. First, one thing we'll talk about today, the EIC framework. And the idea of EIC, which stands for Economy, Industry, Company, is it's an external analysis of a company to understand its performance over time. Because about half the performance of a company is driven by external factors. So we need to understand what those external factors are and how they influence the performance of the industry over time. Second part of the group project will be the historical analysis. So one of the things we'll be doing next week is converting financial statements into an economic format. We'll do that first with historical analysis, and that will help us do an assessment of the company. In order to predict the future, we have to understand the past. So this is really what section 2 of the paper will be focused on. And specifically, what we'll do is we'll do an analysis known as an ROIC tree, looking at the key value drivers of the company. We'll also do a cash flow or a free cash flow analysis of the company historically. Third, and this gets into multiples, we will do the multiples analysis of a company. And there'll be 6 multiples we'll look at: enterprise value to sales, enterprise value to EBITDA, enterprise value to EBIT, price to earnings ratio, the PEG ratio, and the price to book ratio. And you will basically use that as an alternative form of valuation and a valuation check on the cash flow valuations that we're going to do within the class. And finally, you will do cash flow valuations of companies using Excel. And you'll do 2 types of cash flow valuations: what's known as a discounted cash flow valuation and also an economic profit valuation. Now they'll give you the same results, and you'll do 2 valuations. You'll do what's called an as-is valuation, where you value the company based on its current share price, assuming they're public, and you'll do a final valuation where you put in your recommendation for what you think the company is worth, creating the concept of a buy, sell, hold opinion. So those are the major parts of the group projects. Those are the major sections we're going to be completing over the next 5 or so weeks. in advance of the group projects. And that's what we're going to focus on for this class. All right, so what I'd like to do next is talk about the content for today. So on Canvas, under Elm's Canvas, under the Files section, I posted Lecture Note 1, which is available for you to download as a PDF, and that's what we're going to be going through here this morning. So, starting with Lecture Note 1. And I was just checking to see if there were any questions at this point before I go forward. If you wanted to type those into the text box. All right. So a lot of the work that we're going to be doing this semester is based on the work of the consulting firm McKinsey. And generally, you can summarize their views on value creation into 4 themes. And they call these the 4 cornerstones of value creation. All right, first, value is only created when we have a positive spread. And that is going to be very important to value creation. So it's not enough to grow your earnings and grow your revenues over time. Investors are going to look at the concept of return on investment, or how much did you spend for those earnings, and they're going to compare that to your cost of capital to look at what was the expectation of the earnings and the returns given the amount of risk that you took to generate those returns. And that is a concept this semester which we're going to call spread. And we're going to say that value is only created when we have a positive spread. And that is going to be something important for us to assess when we evaluate a company. Second, you can't create value through what we'll call financial reengineering. And I want to be very specific about this. So the idea is that you can think of a company's value based on the amount of cash that it generates and can distribute to the investors. That is what we're going to call the enterprise value. And generally, the enterprise value is going to be distributed to 3 major stakeholders. One stakeholder is going to be the government in the form of taxes paid. A second stakeholder is the debt, and a third stakeholder is the equity. And the enterprise value is going to be split up between those 3 stakeholders. So here's the key. What we would learn in a traditional finance class is that one way to get more cash flow to the stakeholders is to issue more debt, which, if we pay interest, reduces our income, creating something called an interest tax shield, because we can write off as a company the cost of the interest against our revenues. We can subtract that. We can lower our income. We'll pay less taxes. And by paying less taxes, we have more cash available for the debt and equity holders in the firm. And what I want to tell you is that is not value creation. That is what we'll call value redistribution. Because even though by issuing debt and taking cash away from the government in the form of interest tax shields, there is more cash available for the debt and equity holders of the firm, we have not changed the total enterprise value of the firm. We have not changed the total amount of cash that is available to the stakeholders of the government, the debt, and the equity holders. All we've done is reshuffled how much cash with the interest tax shield goes to each of those stakeholders. So by creating interest tax shield, what the government has basically done is given the company a subsidy where the government takes less in taxes and more money is recaptured by the debt and equity holders of the firm. That's not really creating value. All you're doing is redistributing the cash flows amongst the stakeholders. I'm not saying that there's not value to the stakeholders in doing that. And there are lots of industries that focus on that. And if any of you work for accounting firms, it's It's going to be one of the major things that a KPMG or PwC or some of the law firms are going to be focusing on, helping companies avoid taxes. But ultimately, value creation, as we define it, is going to be about enterprise value. How do you have more absolute cash available to distribute to the stakeholders? That is true value creation. Concept number 3. The value of a company is based on expectations of cash flows. So what that means is that from a corporate standpoint, we know that companies are worth the sum of their future cash flows. That's what the academic studies and the academic data shows, that over time, you're going to trade for the cash that you generate. And with big data sets and long periods of time, we see a one-to-one correlation between the cash companies generate and the prices of those assets. Now, here's the challenge. The over time typically is periods of 10 years or longer. Let's say it's 10 years. So in this case, I'm trying to predict the cash flows for a company for the next 10 years. The challenge is I don't know what those cash flows are, so I have to guess. Well, fast forward 10 years. The value of the company is not based on the previous 10 years cash flows. Companies are worth the sum of the future cash flows. The company's value is based on the next 10 years. So whenever I value an asset, specifically equity in this class, I am guessing what those cash flows are going to be. And the guesses result in the value of the firm. So it's very important to understand investor expectations, because it's through investor expectations that we will get a better sense of what the values of the firm are. That is one of the reasons why we use a data service like Bloomberg Professional. So I'm just going to jump to Bloomberg just to give you a sense of this. I have a copy of Bloomberg running on my laptop. So if you go into the lab and you will launch Bloomberg on a screen from the lab, just click on the Bloomberg icon. I'll bring up this screen. And you can choose your language. In this case, I'm going to choose English. Hit the Enter key, which is the Go key, and it will bring you to the screen to log in. Now, the very first time that you go to Bloomberg, you won't have a login, so you'll need to create a new login. So you can click on the screen that says create a new login and basically follow the prompts. It's pretty straightforward. Choose your preferred language. The login is for yourself. If you've ever had a Bloomberg account before, they want to know about it. Otherwise, most of you should say no. And then hit continue. You'll choose a password. They're going to ask you to verify your account by either sending you a text message or an email. You're then going to put the text message or email verification code in. It will then give you your account name, and then you can begin using the Bloomberg service with that account. Okay? So that's the general idea of the Bloomberg screen. So what I'm going to do is I'm going to go back here to the login screen once I have an account, and you'll notice that every machine has a serial number and a Bloomberg ID. And there's also a net ID. They're very heavy into tracking the software. That's another reason why you can't just put this software on any computer, because if you do, software checks these serial numbers in real time against the database, and if it doesn't see an account in your name with that serial number and that machine's ID number, then it just won't load. Anyways, so I'm logging in with my username and password. Bloomberg also has an email program. So let's say that I wanted to do some analysis, and I mentioned Walmart on Walmart. So what I would do is either type in the ticker symbol or start typing in the company's name. And what Bloomberg does, it's smart enough to know who the companies are, and it will show you a list of companies that meet that filter. Now, for Walmart, it's WMT as their ticker symbol. US means it's a US stock, and equity for the equity analysis. You'll also see Corp listed from time to time. Corp means fixed income. Corp is so you can analyze the debt, and Bloomberg is a pretty serious debt service. So in this case, we're going to go to Walmart US equity. I can then click on it. It'll bring me to the equity screen. Again, partial GUI interface. Bloomberg was originally developed in the 80s. So the software was originally DOS and text-based, and it still has a lot of the elements, which means I can either click on an area to look at, or I can type in what's called a short code. These 2 to 4 letter things are short codes. So for example, if I want to go to earnings estimates, I can type in EE, and that will bring me to that screen. And what I'm going to look at is a screen, which we're going to use pretty heavily this semester, called Earnings Estimate Overview. So again, I can get there 2 ways. I can either click on Earnings Estimates, it'll give me the submenu, and then I can go to the Overview, Consensus Overview screen. And this is what I mean by expectation. This is the real-time access to the consensus estimates of Wall Street. So if you're not familiar with the concept of consensus estimates that you read in the press, so for example, Wall Street Journal, every time quarter results, which right now are being released by a lot of companies, they'll say they missed or met their earnings expectations. This is where you get the earnings expectation. By default, it gives you a quarterly view. You can also switch this to an annual view. So for Walmart, in their about to be released fourth quarter 2014 results based on January 2014, right now, the market is expecting $131 billion in sales. If you hover over it, you can see the low to the high in terms of the analysts' expectations. Basically, there are 18 analysts that are in the consensus. So specifically, there are people like Stifel, again, because of our Susquehanna, Buckingham, I'm sure there's a JP Morgan, Goldman Sachs, UBS here in these permission denieds. We don't pay for the highest level of service at Bloomberg, so we don't always get access to all the data. But basically, what happens is, as an analyst, you'll cover a range of companies. As part of that coverage, you'll forecast financial statements. You'll upload your forecast to financial statements. A data service like Bloomberg's or Thomson Reuters will then aggregate the guesses. The average of the guesses becomes the consensus. So right now, Walmart's EPS is expected to be $1.65 on an adjusted basis and $1.54 on an unadjusted basis, GAAP basis. Now, the analysts are more concerned with adjusted, which means I can go as an analyst, I can take out one-time charges or non-cash charges and look at a more reflective earnings per share. Nonetheless, when Walmart reports their earnings, this is the number that's going to be looked at against the quarter. There are 22 guesses that were averaged. You can see the range. You can actually see there are 26 guesses. 4 were thrown out by Bloomberg as being outliers. And the general range for the 22 is between $1.60 and $1.70 a share. Now, again, I can also switch to an annual view, and I can see what 2015, 2016, 2017 look like for Walmart. And so this is what I mean. And by the way, here's the multiples that we're going to be talking about later this semester. But basically, what I can see very quickly is what Wall Street's view of the future is for a company. And one of the things that we're going to realize this semester is that companies trade for the cash expected value of their stock, and the institutional view of that cash value is very important. Another screen in Bloomberg is called Holders, HDS is the short code. And this will show you the institutional investors for a company. And what's important about Walmart is that 82% of Walmart stock is controlled by these 18 institutions. So understanding the institutional view of a company, particularly a large company, is critical because they're going to be the ones that determine the value of a company's stock just because they control so much of it. It's no longer individual investors that control the values of stock. It's now the institutions because they have the concentrated buying power to determine the values of the stock. They use the theories that we're talking about in this class, and they use the expected cash flows to help them with their modeling, which you can see are available to anyone in these data services. But you need to go to one of these paid data services to get a sense of what those numbers really are. By the way, if I look at a company like Amazon, and I look at their holders, 92% of their company is controlled by these 18 institutions. Again, Jeff Bezos, founder and CEO, about 19%, but nonetheless, very concentrated hands of the value of Amazon. You can also see whether people have been buying or selling. So again, Bloomberg is a great tool for us to use. Come back to this in a few minutes, talk about your first homework assignment. All right. So while I'm back here, before I go forward, just questions? Just looking at the text box. Okay. All right. So final cornerstone of value creation says that over the long run, you're going to earn an average rate of return. So the only way you create value is you earn above average rates of return, which means we have to understand the concept of competitive advantage. Specifically, we're going to follow the approach of Warren Buffett. You can really distill Warren Buffett's of Berkshire Hathaway's very successful long-term investment strategy into answering two key questions. Question one, is it a good industry? Question two, is it a good company in the good industry? So when Warren Buffett, and by the way, Berkshire Hathaway, when Warren Buffett took over, it was kind of a textile company that he transformed into an insurance company. And insurance companies basically invest their money for long periods of time before they have to pay out the claims, because we're paying them premiums all the time. They're investing the income and they're going to pay out the claims at a future date. So insurance companies make money on underwriting. They also make money on investable income. And one of the things that Warren Buffett realized over 30 years ago is that if he put his money in a diversified portfolio, he could hire some very smart people, like people in this room, to create diversified portfolios for him, and he'd earn the same rate of return of all the other major insurers in the world. But if he's running companies like Geico and others, what he needs to do is he needs to outperform. So he made a decision that he thought by investing in individual companies, he could actually outperform diversified portfolios over the long period of time. Kind of went against conventional wisdom. But when he looked at his time horizon for investments, he's not a trader. He doesn't make investments and then trade them several months later. He's looking at a 30-year time horizon when he invests in a company. So he wants a company that's going to outperform over a very long period of time. That's where the two questions come into play. So if it's not a good long-term industry, then it's going to be very difficult for the industry and the companies within it to make good rates of return over a long period of time. So one of the things he looks at is industries with good long-term prospects. And so that becomes key to his decision making. If you think about his most recent investments, basically they can be boiled down to three companies: Exxon, Burlington Northern Railroad, and Heinz, makers of ketchup. So let's talk about Heinz for a second. Part of the attraction to Heinz is think, why would you want to buy a company that sells ketchup? Ketchup is a pretty boring, mature food products industry. Well, what Warren Buffett is making a play on is it's actually what's called a protein play, which says that he's looking at the macroeconomic data and he realizes that as countries become wealthier, they put more protein on their diet. Protein means animals, chicken, etc. So here's the challenge, that basically owning slaughterhouses for beef and chicken is a very ugly, dirty, hard to run business. But putting the stuff on the animals, ketchup, for example, on hamburgers, etc., is actually a boring business that not a lot of people go into, but is tied to the growth of the protein play business over time. So that's what he's making. His investment in Heinz is a protein play. Second, find the best companies. Look for companies with great management teams with competitive advantage. And you don't get a bigger brand in the condiment business than Heinz. A very well-run company makes great returns, tremendous brands, has long-term competitive advantage. Find a good market, find competitive advantage. His investment in the railroad. Why do you invest in railroads? Short answer, high energy costs, $100 plus oil. Everyone believes that there's going to be increasing shortages of energy going forward. That means high energy costs. So what it really means is that shipping costs are going to be high because we use a lot of energy to ship stuff around. Well, that gives rail a competitive advantage over trucking. Rail is a much more cost-effective uh, form of transportation relative to trucking when energy costs are high. So therefore, he's looking at high energy costs as a reason to buy into the railroad industry long term as shipping and trade increases and the cost of trade becomes more important. Rail increasingly has an attractiveness and competitive advantage. So he's buying into the rail industry. Second, he looked for the best run railroad. It was Burlington Northern. Third investment was Exxon. One of the things that's been happening in the last 5 years is a transformation of the energy industry, particularly in the US. And fracking is leading the charge. But with high energy costs, demand is growing worldwide. He looked for the industry that's actually growing and he picked energy. And then he picked what he thought was the best run of the major oil companies. He picked Exxon, made his investment. Again, it's easy to be Warren Buffett. We're going to practice doing that this semester. We're also going to understand that companies make trade-offs as they make decisions. And one of the trade-offs that we're going to have to understand in a company is what level of return versus what level of risk are they taking. And we need to understand, are they focused more on return or are they focused more on growth? And are they looking more at short-term performance or are they looking more at long-term performance? And then the final one, which we'll get to in a minute, is what is their margin and cycle time, which are the key drivers of ROIC. But over the long run, there's a key assumption that's playing out here. Whatever cash you generate internally to the firm will be the cash available to the owners of the firm, which means that the price of your stock, assuming it's based on the future cash flow that you generate, will be based on how much cash you generate. So from an external standpoint, the external total return to shareholders or the external return on investment I get by owning your firm will be the same as the internal return on investment or the internal cash flows you generate. Otherwise, there's an arbitrage opportunity. So in the long run, we're going to trade based on the cash flows we generate. Short run, there can be some challenges due to lack of information about the long run. And it could cause an out of balance between these two approaches. Because if I give you the external share price, you should be able to tell me what cash flows led to that share price. And if those cash flows don't lead to that share price, that's where you get the buy, sell, hold. That's also where multiples come in because multiples are based on the external view, the price of the company. And multiples are a principle that says we can work backwards to figure out the price of the company. Cash flow valuation is saying if I know the internal cash flows of the company, I can figure out what the external price of the company should be. So these two approaches actually get us to the same answer. They come at it from a different point of view, but ultimately we are basing our premise on the prices of the companies will be based on the cash flows they generate. That's why when we do cash flow valuation, it's important to understand the expectations of the cash flows because those will drive the values of the companies that we're going to be looking at. All right. Key point for today, which is this is a true story of a company that I've been working with for a number of years. And it basically helps explain difference in share price. So the idea is company A and company B are competitors in the same industry. They sell the same products. They make the same profit margins. They make 8% profit margins on their sales. They say they have the same cost of capital and they have the same growth prospects, growing at the same rate. And the key question here is that company A had a don't buy or sell rating basically on them, and company B had a buy rating on them. And company A was trying to understand why were the analysts excited about the value and prospects of company B if they had the same margins, the same growth, and the same risk as company B. And basically the answer to that question had to do with a concept known as cycle time or days. And cycle time represents the length of time in days that you tie up cash. So from the time you borrow money from an investor to the time you get paid by a customer and collect the cash, how long does it take? So given the time frame of the companies, looked at the annual reports of both companies and calculated their cycle time. Company A cycle time was 267 days. Company B cycle time was 135 days, based on publicly available data. So here's the business model of both companies. If I'm an investor in company A, I put $1 of investment into A, I make 8 cents every 267 days. If I put $1 into company B, I make 8 cents every 135 days. So you can think about this, but the answer should be obvious. Which company sounds more attractive, A or B? Well, for the same risk, I'll take B, because I'd rather make 8 cents every 135 days than 8 cents every 267 days. And that's what was happening in the real world. Now, if you think about it on a cash basis, and this is just a critical but hopefully obvious point. Let's say A and B both start their projects at the same time. On day 135, company A generates no cash profit. And the reason why is the cycle time is how long it takes before the cash is collected from the customer. So on day 135, company A has no cash. But on day 135, company B has 8 cents. They get $1 of revenue. They spent 92 cents of cash along the way. They have 8 cents of cash profit. On day 267, company A now has 8 cents. But on day 270, company B has 16 cents because they use the same resources to complete cycle 2. That's why B starts to look more attractive over time. It's not just the margins, it's how often you earn those margins. So as investors, what we're going to do, we're going to annualize the data. And when we annualize the data, 8 cents every 267 days is about 11 cents a year. 8 cents every 135 days is about 22 cents a year. And I'd rather earn about 22 cents of cash per year than 11 cents of cash per year for the same investment and the same risk. That annualized number is called ROIC, return on invested capital. And return on invested capital has 2 drivers. Driver number 1, margin. Driver number 2, cycle time. It's the 2 together that determine your ROIC. The ROIC is the cash you generate that's available to the investors, which is key to valuation. So just a quick example. I work with a cruise line called Royal Caribbean, makes some of the biggest cruise ships in the world. During this 5-year period, this is a chart of their share price. This is their 5-year ROIC. And here's what I want you to understand. When you make 7.5% ROIC, you're generating 7.5 cents of cash per dollar of investment. I can price that, especially if I expect that to continue for a slow growth company. When the company only makes 6 cents or 3 cents, I can price that. It's worth less than 7.5%. When they're improving their performance, and I think they're going to be doing a lot better in the future, I can price that. And when I realize they're not doing a lot better in the future, I can price that. And 6 cents is less than 7.5 cents, which is more than 3 cents. So the point is that over time, return on invested capital is one of the key indicators of a company's stock price, because it gives us a sense of how much cash is generated. And when we mix it in with growth and risk, it will give us a lot of insight into a company's value. Now, one of the things I want to focus on here, though, is what drives ROIC. It's margin and cycle time determine ROIC. And this is one of the analysis that we're going to do this semester. But one of the things we're going to look at is, why does an ROIC change for a company? So for example, in 2007, the ROIC of Royal Caribbean was 7.5%. In 2011, it fell to 5.8%. Why? Well, their margin went from almost 15 cents per dollar of sales to 12.4 cents. So a lot of it was they're making less profit. But the other part of it was longer cycle times. They went from 709 days to collect their cash to 780 days. So they're taking longer to make less profit, which both together reduce their ROIC and reduce the expected value of the stock. Now, this can directly be tied to their strategy, because their strategy during this period of time was to build these $1.5 billion, 5,000 to 6,000 passenger cruise ships. And these ships, which were getting ever larger, spent about $4.5 billion during this period of time to build out their cruise ships. And that was the problem. The investment was lengthening their cycle time. But given that we've been in a global recession for travel, it's put pressure on their prices. So they were taking longer with all these new investments. They sacrificed their margins, they hurt their ROIC, and there's questionable value about those investments at the time of 2011 to 2011 based on what the stock market was seeing about the future. So one of the things we can do is we can compare ourselves to one of their competitors, and we will. In this case, we're going to look at Carnival Cruise Lines, which is the largest cruise operator in the world. And what's interesting is during the same 5-year period of time, Carnival also saw a declining ROIC, which went from about 10% down to 7.1%. Now, here's what's interesting. Both companies had a very similar cost of capital during the 5 years. It kind of varied between 8 and 9% annually. And if we think about it, here's the ROIC of Carnival. Here's the ROIC of Royal Caribbean. Think about it for a second. What do you think would happen to each company's share price during the 5 years, assuming ROIC is a key driver, particularly relative to cost of capital? And what do you think, which company do you think would have the better performing share price over the period of time? Again, assuming ROIC is a proxy for cash generation. Well, the next slide is a 5-year stock chart. If you invested in either company on the same day, the beginning of 2000 and in this case 8, you would have lost value in either stock. And we could expect that because the cost of capital, previous slide, was 8 to 9%, and both companies had negative spreads. Both companies had ROICs less than their cost of capital, which says that the investors thought it's not worth it and lower stock prices. Carnival lost a little less value than Royal Caribbean during this period of time. Well, again, Carnival didn't see the lower ROICs that Royal Caribbean did. So even though they both had negative spreads, Carnival's was a little bit less negative. Their share price outperformed Royal Caribbean, though both companies lost value. So that highlights another key point to value creation. Value creation is about spread. It's about the level of return you get and what risk you took to get it. So would it make sense if we had a $10,000 line of credit that we had to pay 6% interest for to put it in an investment that makes 4%? Obviously not. We wouldn't want to borrow at 6 to make 4. Well, investors look at the real world the same way. The terminology we'll be using this semester. The $10,000 is called invested capital. It's the money that we borrow and put to work in the firm. The 6% on the previous slide is called the cost of the capital. It's an annualized, risk-adjusted, expected rate of return. And the 4% we earn putting our money to work is called the ROIC, the return on invested capital. And spread is the difference between the two. So in the previous example, we would have had a negative spread of negative 2%. Now, we can also turn spread into a dollar-based number called EVA, or economic value added. If we took $10,000 and then we borrowed it at 6% annually, 6% cost of capital, we would owe, keeping compounding interest out of this, $600 in what's called a finance or a capital charge. We have to make $600 to pay 6% back on $10,000. If we made $400 of profit, 4% on $10,000, and we compared that to the $600 we needed to make, we were $200 short. That negative $200 would be called negative EVA of 200 or negative economic profit of 200. So EVA is also spread. It just turns it into dollars. The key to value creation, we have to have a positive spread. We either have to have ROIC greater than our cost of capital, or said another way, we have to have profits greater than our capital charge. And we're going to take both points of view when we analyze companies this semester. So as we think about cycle time, I just want to talk to you briefly about how you calculate cycle time for a company. I was doing some work with a beer company, Molson Coors, last year. And again, through publicly available data, I was calculating their cycle time. You need to know two pieces of data. One, what's a company's invested capital? Two, company's total annual sales or revenue. If you take the invested capital, which is the borrowed money that's put to work in the business, and divide it by the annual sales or revenue, you get the percentage of the year that the capital is tied up. Just multiply that by 365 days, translates it into days. So here's some data points for Molson Coors. In 2011, again, I did this about a year ago, right before they reported their earnings. They had sales of $3.5 billion. They had after-tax profits of $411 million. They had invested capital of a little over $2.7 billion, and they had about $1 billion of cash on hand. So I knew that their cycle time was 287 days long because I took the 2763, I divided it by the 3516, and I multiplied by 365. So basically, I know that Molson Coors in 2011 was tying up cash at an average rate of 287 days. So from the time they borrowed it to the time they collected in sales, on average took 287 days. I also know that 287 days resulted in almost $2.8 billion of borrowed money. So that's the point. Why do profitable companies borrow money? They borrow the money to fund the cycle time. And so more cycle time, more borrowed money. Less cycle time, less borrowed money. If they're borrowing $2.8 billion to finance essentially this 287 days of cycle time, that means each day of cash is about $10 million. So if they get 20 days faster, they free up $200 million. If it takes them 20 days longer to build their products and get them to customers, they need to finance an additional $200 million. So cycle time is another way of expressing productivity, which is another way of expressing the amount of capital and financing that is tied up by companies. I also know that they had $1 billion worth of cash. And at $10 million a day to finance their balance sheet, that cash is going to last for approximately 105 days, doing the math. So divide the 1,009 divided by 10. Again, there's some rounding going on here. But the point is they got about a little over 100 days worth of cash. So that's the idea. They have 100 days of cash on hand. They need 287 days of time before they get paid. That's why companies are borrowing money, because they have to finance the difference between the cash they have and the time they need to get it back. So it is that cycle time that is really what invested capital is being driven by. Longer gaps, more invested capital. Shorter gaps, faster cycle times, less invested capital. Work with the other beer companies. If I look with them, when I'm working with Molson Coors, one of the things I would do is I would compare their cycle time versus the industry. And as long as their cycle time seems, by 2011, they were actually faster than the average of their peers. Although interestingly, it was Boston Beer that had the fastest cycle time in the industry. The lowest cycle time was SAB Miller. All right. Another company I do some work with is Rio Tinto, big mining company based in London. And I calculated their cycle time in 2012. It was 572 days. They had almost 80 billion of invested capital on about 51 billion in revenue. That meant, if you did the math, that invested capital of 79,909 divided by 5967 divided by 365 was 572 days. 572 days into 79,909 meant they were tying up about $140 million worth of debt per day. So that's where you get the cash per day that's being tied up by Rio Tinto. One of the things Rio Tinto did at the beginning of 2013 is they fired their CEO. They brought in a new guy. And one of the things he's been doing is he's been cutting capital expenditures. He's been cutting money, cash spending out of their budget. He promised $5 billion to investors of cash savings when he took over. And one of the ways he's been doing it is they've been improving their efficiencies, cutting their cycle time, how long it takes to get ore out of the ground to the customers. And that has been freeing up a lot of the cash and helping them achieve their $5 billion savings. And we can also track to see this performance over time. One of the challenges Rio Tinto had was that between 2008 and 2012, which is one of the reasons why the previous CEO was terminated, is their cycle time went from 418 days to 572 days. And we can break it into three component parts: working capital, spending on PP&E, spending on acquisitions, which are called intangibles. And you can see that it was really the increase in PP&E, property, plant, equipment, which went from an average of 281 days to 538 days. By the way, at the bottom of this page, it's the same equation, just without the 365. So said another way, in 2008, to generate $1 of revenue or sales, Rio Tinto borrowed and spent $1.15. To generate the same dollar of sales by 2012, Rio Tinto borrowed $1.57. They tied up this cash for 418 days. The cash being tied up went to 572. And you can see that as the cycle time went up, what's interesting is their margins were about the same during the 5-year period, but the ROIC went down from 14 to 10%, and their share price went down as well, mainly because of all that excess spending and all that lengthening cycle time really hurt their margins, hurt their ROIC, hurt their value, cost the CEO his job. And during this period of time, they also had a negative spread. They were taking a lot of risk to generate these returns, and they did not meet their cost of capital. All right, so we'll get into this more next week, but basically this is a graphical representation of Modigliani-Miller. And what it says is that a company's worth the sum of its future cash flows. And what we're going to do is we're going to break the cash flows into what are called operating cash flows and non-operating cash flows. Operating cash flows are the primary cash that comes from customers. Companies also generate non-operating cash flows, such as they have excess cash lying on hand. Maybe they own a piece of another company they don't control. There's some value to that. Maybe they also own some land lying around. So add the two values together, you get what's called the enterprise value. It's that enterprise value which is used to pay off the debt and the equity holders. As a matter of fact, if the enterprise value pays off the debt, whatever's left belongs to the shareholders, divided by shares is share price. That's enterprise DCF valuation. What I want to focus on for about the next 15 minutes is operating value. What drives operating value for a firm? So, model of two simple companies. We have a company that generates, and I'm going to just do this very simply to define some terminology and show you this example, that generates $100 million of what's called no plat or no pat. This is operating profit after tax, or net operating profit less adjusted taxes. Basically, your EBIT times 1 minus the tax rate. So, assumption. This company takes $50 million of its profits and it reinvests in the business to sustain and grow its business. It takes the other $50 million of the profits and it pays out a dividend to the investors. This creates two ratios known as the reinvestment or investment rate, 50%, 50 divided by the 100, and the payout rate, 50 divided by the 100. These two ratios have to add up to 100% of the profits. So 1 minus the reinvestment rate is the payout rate. 1 minus the payout rate equals the reinvestment or investment rate. So two new terms: growth, free cash flow. Growth, also known as sustainable growth. This company, if you look at the previous slide, reinvested $50 million. Assumption. This company made a 10% return on its investment in the past. It makes a 10% return on investment in the future. We're just going to use that assumption to keep the math simple. So if it reinvests 50, makes 10% on the 50, it'll have 5 million of new profits. If it had 100 million of current profits and the ROIC doesn't change, it'll make 100 million on its core business next year. It'll make 5 million on the new investments. It'll have 105 million of profits next year. Its growth rate is 5%. Now, mathematically, we can shortcut this by using this formula. The growth rate of the company, or sustainable growth rate of the company, is the investment rate, 50%, times the ROIC, 10%. 50 times 10 is 5. So the sustainable growth rate is a function of the investment rate and the ROIC. So in this case, let's say that this company wanted to grow at 10% a year. Well, assuming it didn't do an acquisition, or assuming that it didn't get a whole bunch of external leverage, that basically what this company would have to do is it would either have to increase its investment rate to, in this case, 100%, 100% times 10 is 10%, or it would have to get 20% ROIC on the same level of investment to get 10% growth rate. But something would have to change in order to increase its growth. And this is what's known as the sustainable growth rate, or what often people will talk about as the ability to get organic growth of a company. So, for example, yesterday I was on the phone with a CFO and this head of strategic planning, and we were having this very conversation because he basically said in his business, they can't borrow additional money. The board is constraining their borrowing, yet they're being told they need to grow much more rapidly. So one of the things we looked at is what rate of growth could they grow at with internal funds, given an expectation of some level of dividend and given an expectation of the returns on investment going forward. And we could kind of work out the idea of what type of sustainable growth rate without acquisitions could the company really grow at. Second concept, free cash flow. Free cash flow is defined as profit after reinvestment. Profit of $100 million, reinvestment of $50 million, that leads to what's called free cash flow of $50 million. The value of a firm is not its future profits. Let's say that again. The value of a firm is not its future profits. The value of a firm is its future free cash flows. The reason why is because I can't, if I make $100 million, I can't give it to my investors. And the reason I can't give $100 million to my investors is I took 50 million of it and I reinvested it. So the only thing I can give to my investors sustainably is what's left after reinvestment. That's called free cash flow. Free cash flow is the theoretical payout rate of a company, and it is the value to the investors. Only when we have free cash flow can we create value. One way to think about free cash flow on a personal level is that if you have a job, profit is like your take-home pay, and investments are like your monthly expenses. When your monthly expenses are greater than your take-home pay, you can't save money. You actually have to borrow money. Well, same thing with a company. When the investments are greater than its profits, it's going to have to borrow money. It's not going to be able to distribute cash to the investors. If your monthly pay is greater than your monthly expenses, then you have discretionary income. Then you can invest. Then you could do other things. Same is true with a company. So free cash flow is the value of the company on a go-forward basis. That's why we're going to spend a lot of time figuring out what the company's free cash flows are in the future. And that's why we're going to spend next week reconverting the economic statements to calculate free cash flow. So a lot of our time this semester is going to be figuring out free cash flow. Free cash flow is the cash coming from the income statement, which is known as the cash from operations, minus any cash reinvested in the balance sheet. And the difference between the two is going to be called free cash flow. So I mentioned Royal Caribbean Cruise Lines. When we formally rearrange free cash flows, this is one of the analysis you're going to have to do on your group projects later in the semester, is here's 5 years worth of free cash flow for Royal Caribbean, and this total just sums up each of the categories for the previous 5 years. What we're going to do is we're going to map the cash flows of the company to the Modigliani-Miller model. Here's what's known as the operating cash flows, the free cash flows. Here's the non-operating cash flows, and here's the debt and equity cash flows. And we're going to show that the operating and non-operating cash flows equal the debt and equity cash flows, that there's an equivalence to that. What's going to be important in this class is that we show that those numbers are equal and balanced. Meaning we're going to track not just how much cash a company generates, we're going to track where it spends it, and we're going to show that they're equal. Two advantages. One, tells a story about the company. Two, make sure we get it right. So if we just forecasted a company's free cash flow and we don't balance it, we don't know we didn't make a mistake. If we forecast the free cash flow and we track exactly where it went and we balance it, we know we didn't make a mistake and we're more likely to be right. So in this case, let's do the 5-year summary for Royal Caribbean. Over this 5-year period, they had negative free cash flow of about negative $1 billion. The reason is they generated about billion of cash profit from their income statement, and they put $7.9 billion back into their business. Or about $1 billion more went back into the business to reinvest and grow versus what they were generating cash profit, all of it in capital expenditures. So this is the building of the ships. So their reinvestment rate, this is a percentage of gross cash flow, is basically 115%. So for every dollar of cash profit, they put $1.15 back into the business. 122.5% of every dollar, primarily on capital expenditures. Well, after non-operating cash flows, they were $1.2 billion short, which means they had to go borrow $1.2 billion. Well, where did they get the money? Well, they had $1.7 billion of interest expense in the debt they already had, which means they were $1.2 billion short and they owed $1.7 billion in interest. Well, they borrowed $3 billion in new debt. And it's pretty obvious why they did it during this 5-year period, because it funded the negative cash flow to build the ships and it paid the interest they already had on the debt. They also spent about $250 million in dividends, although not very much in the last 3 years, mainly because there wasn't a lot of cash flow to be paid out. So, and they bought back some shares. They also issued some shares. But really, if you want to look at the story of Royal Caribbean, its negative cash flow led to big debt issuance over the 5-year period of time. Let's look at Carnival during the same 5 years. Carnival generated almost $18.7 billion of cash profit from operations during the same 5 years. They were bigger. But here's the thing. Carnival did not invest as much of the cash back into growth as Royal Caribbean did. They put $14.4 billion back in, generating positive free cash flow of $4.2 billion, which meant their reinvestment rate was closer to 70, in this case, 77%. So Carnival basically had a 77% reinvestment rate. Royal Caribbean had a 115% reinvestment rate. Carnival generated $4.3 billion of free cash flow. Royal Caribbean had negative cash flow of $1 billion. After non-operating activities, Carnival generated almost $800 million more of non-operating cash flows, having $5.2 billion of what's called cash flow available to investors to pay out. What did Carnival do? During the same 5-year period, they also had to pay some interest on the debt they had, about $1.9 billion. They also increased their debt. But notice the story. Carnival's debt increase was discretionary. Royal Caribbean's debt increase was necessary. They didn't have to borrow this money because they generated cash flow. Let's see why. Carnival paid $3.4 million in dividends and repurchased $1.7 billion worth of stock. So if you really look at it, Carnival leveraged their balance sheet, but they leveraged it while generating sufficient free cash flow to pay the dividends and to buy back the stock. Right? Whereas Royal Caribbean couldn't really afford the dividends or share repurchase because they didn't have any cash flow because they spent more than they generated. So the other reason why Carnival outperformed Royal Caribbean during this 5-year period of time is from an investor standpoint, even though they were in a negative spread situation, they were still returning cash back to the investors. And the investors appreciated that, which is why they rewarded them with a share price that outperformed. All right, key slide. Tying all these concepts together. Back to hypothetical company A. This company doesn't exist. But I'm going to add a competitor, hypothetical company B. So we have A, we have B. Both companies have identical profits, $100 million. Both companies are growing their profits at 5% a year, 100, 105, approximately 110, etc. And these percentage growth rates are expected to continue in the future. So identical profits, identical growth rates. Same cost of capital. Which company is more valuable, A or B, given everything that we've said today? Well, as you think about that, what drives value? We said it's not the future profits, it's the future free cash flows. So look at the free cash flow of A, look at the free cash flow of B. Notice the free cash flow of B is greater than the free cash flow of A for the same profits. If this is expected to continue, and these are the actual numbers that occur, then B will be more valuable than A because it generates more free cash flow and therefore at the same risk, more free cash flow is more valuable. Now, follow this reasoning as to why. The reason B generates more free cash flow than A is because B doesn't have to spend as much, less investment, to generate the same amount of profits. The reason B doesn't have to invest as much to generate the same profits is because B makes a 20% return on its investment. A makes a 10% return on investment. This is the clearest and simplest way that I can show you that if you have a higher return on invested capital, you will generate more free cash flow over the long run. So, for the same growth rate. And that's why return on invested capital is such a critical metric for companies, because figuring out your free cash flow is hard. Figuring out your ROIC is easy, and ROIC is one of the determinants of your future free cash flow. So if you consistently generate more ROIC, then I know you will generate more free cash flow and you will become more valuable. And it's easier to figure out your ROIC than your free cash flow, even though they should eventually give us the same answer. So we use ROIC as a proxy for future free cash flow. Now, I could have shown this example a slightly different way. And what I could have done is I could have shown you that both companies invest the same amount of money. Well, both companies A and B had the same investment, then B would have more profit for the same level of investment. And so in this case, what I'm showing you is that B doesn't have to invest as much to generate the same profits. It's really saying the same thing, but in either case, B will generate more free cash flow than A at the same level of growth because it has this higher return on investment. Now, how do we value firms? The difference between a firm and a project is we assume firms last forever. Well, in order to value a firm forever, we use what's called a growing perpetuity to value a firm over a long period of time. Here's the growing perpetuity. Cash flow divided by R minus G. Cash flow is free cash flow. R is the weighted average cost of capital. G is the long-term growth rate. Problem with the growing perpetuity formula is a math problem. It assumes that the internal rate of return on future cash flows is the same as the internal rate of return on historical cash flows. Translation, whatever rate of return you made in the past, you'll make forever. So if I apply this formula to a company that's doing really well, I will overvalue the firm because it will never do poorly and it will do well forever. If I apply this formula to a firm that's not doing so well, I will undervalue the firm because it will do poorly forever and it will never improve. So the idea with this formula is the growing perpetuity exaggerates the directionality of the performance of a firm. So here's what we're going to do. We're going to use a variation of this formula known as key value drivers, or KVD. And the formula on the right is the same as the formula on the left. And here's the idea. Free cash flow is profit times 1 minus the reinvestment rate. Sustainable growth is investment rate times ROIC. So investment rate is growth over ROIC. The formula on the right is the key value drivers formula. Here's what's different. With the formula on the right, we can now project profit and ROIC into the future because this is incremental ROIC in the future. With the formula on the left, we can't. We can only project free cash flow. So by using the formula on the right, which McKinsey calls key value drivers, it is a version of the growing perpetuity formula, but this ROIC is future incremental ROIC. Now it's one ROIC for the entire future of the firm, but at least it could be more representative of the future. So let's apply the KVD formula. So in this case, I want to go back to company A and B, and I want to value them using key value drivers. So I'm just going to do it in Excel. So we have company A, we have company B. We then have we then have profit, we have growth, G, we have ROIC, and then we have cost of capital, or the WACC. Those were the 4 elements of the formula. And that will give us our value, and that will give us our valuation, and eventually it's going to give us something called our multiple. So A and B both had 100 million profits. I'm just going from that previous slide. They were both growing at 5% a year into perpetuity. A had a 10% ROIC. B had a 20% ROIC. And both companies had the same 10% cost of capitals. Using the key value drivers equation, A would be worth profit times 1 minus growth divided by ROIC divided by cost of capital minus the growth rate. A would be worth $1 billion and B would be worth $1.5 billion. So intuitively, we thought B would be more valuable. Now we've just done the math and we've proven that B is 50% more valuable than A. Now, if we were to do something called a price to earnings multiple or an enterprise value to profit multiple on company A, their price to earnings, price, the value of the company, divided by the earnings, the profit of the company, they would trade at a multiple of 10 times earnings. B would trade at a multiple of 15 times earnings. So B is more valuable. B would have a higher PE ratio. Multiples are very much related to cash flow. As a matter of fact, what drives multiples? It's right here. 3 things primarily drive multiples: growth, return on investment, risk, cost of capital. Growth and spread are the primary drivers of multiples. In this case, why is B more valuable than A on a multiple basis? Well, look, what's different? ROIC is the only differentiator. Higher ROIC, higher value, higher multiple. So what happens if the companies double their profits? What happens to their value and their multiple? Notice that their value doubles, but their multiple doesn't change because growth, ROIC, and cost of capital drive multiples and they don't change. So if absolute cash flow gets higher at the same growth rate, the same return, the same risk, the companies are more valuable, but the multiple doesn't change. The cash flow isn't more valuable. It's just you have more cash flow that is a value. Now, how do I make the multiple higher? How do I make my cash flows worth more? Well, let's look at changing growth. 6%. 7%. 8%. 9%. Notice that as A grows faster, the value in the multiple doesn't change. But as B grows faster, the value in the multiple goes up exponentially. Reason for that is spread. The spread of A is 0. I borrow at 10, I invest, I make 10. 10 minus 10 is 0. For B, my multiple is higher because I have a positive spread. I borrow at 10, I invest and I make 20, and I do that more often. So with a positive spread, the higher growth exponentially makes the multiple higher. I'm going to reset this. What if growth slows? 4%, 3%, 2%. What's happening here is the expectation game with company B. At company B, I bought them assuming they were going to grow at 5%, assuming they were going to earn this level of return and this level of risk. I priced that. But then in reality, they only earn 2%. So I have to adjust my price down because they're not getting as much cash flow as I originally expected. This is how companies, and you think Apple Computer went through this when they got to like $750 a share, and now they're trading in the 500s after dropping down to the 400 range. It wasn't that Apple was making any less profits on its business. The problem is the market realized that the growth rates were unsustainable and they had expected them to grow much faster than they were able to achieve. When they started lowering the growth expectation, it lowered the value, it lowered the PE of Apple. Final scenario, negative spread. What if A had a negative spread? Its cost of capital was greater than its ROIC. Now look what happens when it grows. 6%, 7%. The faster they grow, the worse off they are with multiple and the more value they destroy. This says that if I grow at a negative spread, I destroy value at a faster rate. Not all growth is good. So what should company A do in this scenario? Growth of 3%, growth of 1%, growth of negative 1%. They should actually try and shrink. Avoid the negative NPV investments. Avoid the negative spread investments. So this gives us kind of 4 scenarios to understand for understanding what happens with a company's value. And these principles we're going to apply again and again and again throughout the semester. So this is a really core topic to understand. So this little simulation, I'll post this model on Canvas. You can play with it yourself. But ultimately, back to PowerPoint here, you take out all the math. 3 things drive multiples. 1, spread. 2, growth. 3, sustainability. Spread is key to value. If you don't have a positive spread, ROIC versus cost of capital, you can't create value. And we talked about earlier in this module, 2 drivers of ROIC, margin and cycle time. Those are the drivers of ROIC. Second, and this is probably a little more controversial, growth. Growth does not create value for a company. I'm going to repeat this. Growth does not create value for a company. Growth is an accelerant to value. Growth is like throwing gasoline on a fire. If I grow my business that has a positive spread, I create value at a faster rate. If I grow a business with a negative spread, I destroy value at a faster rate. Finally, sustainability. How long can I maintain that ROIC before it starts to shrink? That's competitive advantage. That's the markets that I'm in. Those 3 things are the ones that we look for when we look for value creation. Can you earn a good rate of return? Can you grow that over time? And can you do it in a sustainable way that will be a good market and hold up to competitive pressures? That becomes key to value creation. And that's what we're going to be exploring this semester. So, about 10 more minutes and then we'll be done. The last part of the section is going to be on the EIC framework. E stands for economy, I industry, C company. And this is going to be your first homework assignment. The idea is we're trying to understand the external factors that determine a company and an industry's ROIC over time. So we'll start out with E, economic analysis. The key to economic analysis is understanding what is going to happen in the economy, and based on changes to the economy, what will happen to the stock price of a company. So first, we're going to talk about economic indicators. And we're going to talk about what drives a company's change relative to the economy. So companies' changes relative to the economy is going to be based on the idea of a beta. So let's look at McDonald's. We can go to a data service like Bloomberg, and that's what you're going to have to do, and you can get a beta of a stock. And what it will do, and this is a 5-year beta of McDonald's, is Bloomberg will quickly calculate for you in this case it's done on a weekly basis, the weekly price change of the S&P 500 index against the weekly price change of McDonald's. It'll plot out the data points, it'll draw a trend line, slope of that trend line is the beta. In this case, 0.469. So what this tells me is that if the S&P 500 index changes by 1% over the last 5 years, McDonald's tends to change 0.469%. If the index goes up, McDonald's doesn't go up as faster. If the index goes down, McDonald's doesn't go down as fast. And the idea is that we're going to say the stock market is correlated to changes in the economy. So in a good market, the market goes up, McDonald's doesn't go up as fast. In a bad market, the market goes down, McDonald's doesn't go down as fast. McDonald's is much more of a safety stock, has a lower beta. So when we do analysis, McDonald's is going to be much less sensitive to changes in the economy. So again, I'll go back to Bloomberg. To get to a beta in Bloomberg, what we'll need to do is, let's say I was looking at Amazon. So again, I go back to Amazon, US equity. I type in beta, B-E-T-A. I hit enter. And this will give me a real-time 2-year beta for Amazon. Now, there's something called the raw and there's something called the adjusted. And again, US companies are default measured against the changes of the S&P 500 index. If I wanted to, I could change the index. But the adjusted beta is just a statistical argument that moves the raw beta 1/3 closer to the mean, with the idea that we use a bell curve, and again, over time, betas tend to regress to the mean, so it just puts in a regression coefficient. Bloomberg defines the adjusted beta as 2/3 of the raw and 1, and then they do a weighted average. In this case, for our purposes, we're going to use the raw beta to look at economic sensitivity. So Amazon, for the last 2 years, has had a raw beta of 1.392. If I want to do 5 years, I just switch this. Instead of 2012, I go back to 2009, I hit enter, and it will then in real time redo the beta. So Amazon raw beta over the last 5 years, 1.128. Now, to take a screenshot in Bloomberg, there's an export button here, because you can't bring Bloomberg with you, but you can take screenshots. Hit export, save screen as file, put it on the computer. You probably need a thumb drive or email to yourself. And I'll just take a screenshot. I'll name it Amazon-beta, saves it as a GIF file, and I now have a screenshot of Amazon's beta. So as part of your homework assignment, you'll need to do a 5-year beta following this exact process for the company I give you, and you'll have to look at their beta and basically make the determination that if the beta is well above 1, then they're going to be more sensitive to changes in the economy. If it's less than 1, less sensitive to changes in the economy, and if it's around 1, they're going to go up about as fast or down as fast as the economy. Very important when we think about forecasting of a company, but that's the determination we're going to make for economic sensitivity. Next thing is what's going to happen to the economy. Well, for that, we're going to use the Conference Board as a data source. There's many forecasts of the economy, but one of the key things that the Conference Board does is it publishes every month something called the LEI, the Leading Economic Index. The key to the LEI is that, and this is kind of hard to see, but these gray bars represent historical recessions over the last 50 years. And what you can kind of see if you blow this up a little bit is that the LEI tends to start going down, Leading Economic Index, which is made of these indicators on a weighted basis, before recessions start. So the idea is that the LEI is predictive of economic activity generally about 6 months in advance, a couple of quarters in advance. So one of the things the market closely watches is what happens to this Leading Economic Index. Because right now the economic index has been going up, which has signaled expansion in our economy. But when the LEI starts trending down, we have historically had recessions. So if the LEI starts trending down, you're going to see a lot of economic nervousness in the marketplace. They also publish something called the coincident index. The idea of the coincident index, which is made up of these factors, this tends to go down as recessions start and go up as recessions are ending. Or the LEI tends to go down before recessions start and tends to go up before recessions have actually ended and the economy starts to improve. So the coincident means the name. It goes up and down more with the economy. There's also something called the lagging index. The lagging index goes down after recessions start. The lagging index tends to go up after recessions have ended. Here's a nice chart, which all of you will have a version of this in your final presentation, which shows the LEI and CEI over a shorter period of time, and it shows it on a monthly basis. So the idea is that recently the LEI has been going up and is expected to continue to go up. So the real question is, in an improving economy, given the beta of a company, is it going to be more or less sensitive to changes in the market? That's the first question you're going to have to answer on your homework assignment. Second question you're going to have to answer is the attractiveness of the industry. We're going to define attractiveness of an industry based on the ROIC of the industry against the cost of capital of the industry. we're going to define an attractive industry as one in which the industry ROIC is greater than the industry cost of capital. Again, we're going to use Bloomberg to do this. So if I go to Bloomberg and I'm at Amazon, let's say I do a different company here, just as an example. I'm going to do Target, been in the news recently with all their data breaches. So I'm going to go to Target, and I'm going to go to their beta, and I'm going to go to their 5-year beta, which their 5-year beta, 0.82. So one thing I could say is Target is a little less sensitive to changes in the economy on a go-forward basis. File, export, save screen as file, so I can have us copy the screenshot. Second section I'm going to do in Target is I'm going to go to what's called RV, which used to stand for relative valuation, and it's my way of doing what's called a comparable analysis. So I click on RV. Now, what RV allows me to do is quickly compare relative valuation, is quickly do an analysis of a company against its peers across any ratio in the database. Now, there are some predefined templates in Bloomberg. So for example, here under what they call comp sheets, I can look at a profitability set of ratios, and here's some predefined ratios against Target and its peers across those ratios, again in real time. It's a nice feature of Bloomberg. So in this case, for a comp source, I can either use the Global Industry Classification Service managed by Standard & Poor's, which is basically using SIC codes or the GICS codes of people that are in their code against industry groups. And I can also go down to a sub-industry or an industry. Bloomberg also has something called the Bloomberg comps. And the Bloomberg comps means somebody at Bloomberg has actually gone in and put in who they think their peers really are, as opposed to using the standard industry classification service. So for your homework assignment, you're going to need to go and get the Bloomberg comps. Okay? And as part of the Bloomberg comps, one of the features that you can do for Target against its peers, and I'm going to give you a different company, not Target, is you can click over here on custom. And here you can put in your own ratios. We'll start out with a blank template, name, ticker, market cap. And I can add my own columns. In this case, I'm going to add in ROIC. It'll show me the matches. In this case, return on invested capital. I'm going to select that one. And I want it based on not the latest filing, but the latest year. And then I want to hit enter. Okay, so their latest annual ROICs are over here. And then I want to compare that against the WACC, WACC, weighted average cost of capital. Again, select it, hit enter or go, and there's the weighted average cost of capitals for all these firms. Current WACC against annual ROIC. And then what I'm going to do is I'm going to come down here to select stats. And I'm going to do a market cap weighted average, which will average this against the peers based on the market values of the firm, giving more weight to bigger firms. So what I have is what is the average ROIC for Target and its peers, and what is the average cost of capital. Industry ROIC, industry cost of capital. Now, what I can do is I can save this as a template for reuse. So I'll call this my 760 section 501 template. Well, so many letters you can have in there. And so the nice thing is every time I come in to custom, I can go on one of these templates and I have my saved template that automatically is filled in for any company. Okay. So what you'll need to do is you'll need to take this screen for the company that I give you, calculate the industry ROIC, calculate the industry WACC, file, save screen, Target, call it RV screen, and then save that screenshot. And one of the questions I'm going to ask you in the homework assignment, is this an attractive industry and why? And the answer that you'll get in this case is the industry cost of capital 7%, The industry ROIC is 14%. The ROIC is much greater than the cost of capital. Therefore, this is an attractive industry. Okay. Final part of your homework assignment, to assess whether or not a company has competitive advantage. We are going to define competitive advantage very specifically in this class to say competitive advantage occurs when a company's ROIC is greater than the industry ROIC. So very important. Competitive advantage is not based on spread. Competitive advantage is based on relative ROIC to the industry. So if you don't have an ROIC better than the industry, you don't demonstrate competitive advantage. You have to have an ROIC better than your industry to show competitive advantage. Back to Bloomberg, back to Target. Does Target have competitive advantage? The answer is no. Even though they have a positive spread, even though they earn 9.79% against a 6.85% WACC, their ROIC of 9.79 is less than the industry average of 14.26 compared to their peers. Therefore, Target does not demonstrate competitive advantage, even though they have positive spread. All right, let's do one other quick company. McDonald's is in your slide deck. Say I went to McDonald's, RV, Bloomberg peers, custom. Here's my template I just created. The only thing I need to do is I need to always select my stats and go to market cap weighted average. Why they don't add that to the template, I don't know. So is McDonald's in this fast food industry? Is this an attractive industry? 22% against 8.5%. Yes, very attractive industry. Does McDonald's demonstrate competitive advantage? No. Even though they have a terrific ROIC of 20%, the industry average is currently 22%, and therefore McDonald's does not have competitive advantage. So those are going to be the three things in your homework assignment. You're going to have to sign up for a Bloomberg account. You're going to have to get the beta and the screenshot of the beta for the company and basically talk about whether or not the 5-year beta of a company, so for the beta for McDonald's, 5-year beta, change this to 09, tells you whether or not the company is economically sensitive. In this case, a beta well below 1, 4.34, much less sensitive to the economy. You'll then have to get the RV screenshot, custom. Here's our template. Make sure you have the Bloomberg peers. Select stats, market cap weighted average. And then you'll answer the question on, is it an attractive industry? Does the company that I give you have competitive advantage? I will post a homework assignment later today. In this homework assignment, I will give you the company and the industry that I want you to analyze. The industry will be the peers of that company. And those are the three things that you'll have to do by next Wednesday. So your homework will be to get a Bloomberg account, get the 2 screenshots for beta and RV, submit those screenshots, answer the 3 questions, and that will be good practice. We can clarify this assignment on Monday because this will not be due until a week from today. So if you have any questions, we can talk about it during class. All right. This is going to conclude our first class for today on the snow day. Again, I will post this as a YouTube video later today so that you should have access to this while you're working on the homework assignment. And hopefully we'll see everybody live on campus in the first floor of Van Munching Hall next Monday at 8:30. Again, welcome to Applied Equity Analysis. Otherwise, have a great weekend.